to another Southbank investment bulletin. So here's the UK CPI, which is the conventional way of measuring inflation. It's a year-over-year comparison. So it's still sitting around 10.5%. So that's the highest it's been since the early 1980s. One thing that's also worth highlighting is that the big inflation in the 1970s actually peaked in about 1974, and the big move higher in 1979 through 80 was a lower high. And that's quite different from the experience of the USA. That I think is just some piece of knowledge to keep in the back pocket. But we're at 10.5% on inflation, and it looks like it has peaked. But the Bank of England today raised rates, and they're up to 4% now. And the chances are they're going to go for another 50 basis point hike at the next meeting. But the problem, of course, is that the UK is in a recession. And the Bank of England is pretty much inhibited from raising rates to 10% to try and kill off inflation quickly. They're going to have to go do it in half measures. And one of the things that they have, let's just, well, I guess, think about what are the tools that the Bank of England has at its disposal. Well, the first, of course, is interest rates. So they can raise interest rates, and then that cuts off availability of credit, increases the cost of credit, and obviously then that's significant in terms of reducing some of the inflationary pressures. But of course, inflation's at 10% and the interest rate's at 4%, so you still have very sharply negative real interest rates. What's the other thing they can do? Well, they could reduce the size of their balance sheet, and that's something that, for example, the central bank in the USA, the Federal Reserve, is doing that, and the ECB is doing that, and we can just put that up for the ECB, just to give you an idea of just how quickly the ECB is contracting their balance sheet. It was at almost 9 trillion at the end of last year, and we're down below 8 now. So, and they said they weren't even going to start until February. So they've already taken 1 trillion off, and that's just for starters. And the ECB also raised rates in here today. So with those are two of the tools, but I think the third tool is the thing that the Bank of England has been making the most use of, which is to talk the market down. So you had Andrew Bailey out today saying, well, we have a terrible recession, and it's going to be a long time before we get back to growth, and things are looking really dreary. And obviously, that's terrible for sentiment, and it makes people feel terrible. And of course, that's what the Bank of England wants. They want people feeling terrible. They want people keeping their hands in their pockets, staying at home, not spending, and trying to bring down inflation. So basically, the Bank of England is trying to talk the market down. And they're doing a pretty good job of that in terms of consumer sentiment. But what we are definitely seeing is that the stock market didn't get the message. So the FTSE 250 was up in really quite emphatic fashion in here this week. And it has now clearly broken the downtrend. We can see uh, there is a rivetingly consistent sequence of lower rally highs that was evident all the way through until about the end of last year. And then we had a pop on the upside and a little bit of a wobble, but now a big move here. Well, what that is beginning to suggest is that the stock market is looking past the pace of interest rate hikes and thinking more in terms of what's going to happen after the recession. The economy will likely turn back towards growth, and there'll be more enthusiasm when inflationary pressures start to moderate. And if global growth picks up, well, then that will also be positive for internationally oriented companies. So the FTSE 100 was also in positive territory today. But more important than that is that this index really hasn't gone anywhere for 23 years. And now we're right in the cusp of the all-time highs. So there's really the potential here that the UK is going to pop on the upside, that the stock market is going to lead the economy. And with both the domestic economy represented by the FTSE 250 and the global economy represented by the FTSE 100, well, that at least lends some credence to the view that we're going to have a bout of surprising activity, which is, I think, most likely to come in the form of inflation coming down faster than most people anticipated. There will be economic stress uh, in the future, but between now and then, there is clear scope for a significant rebound. And it's when they start cutting interest rates in future, that's when we need to pay attention, because it's unlikely, having gone through this incredible ordeal of inflation, that central banks are going to cut rates until they have a really good reason to. And that really good reason would be collapsing inflation on the back of economic weakness or higher unemployment. But between now and then, there is clear scope for a significant rebound in markets. And I anticipate that we'll have a very positive performance in the first half of this year. What happens in the back end of this year is anyone's guess. And I think that's something that's very clear. Then let's think about the oil price. And there's a lot of talk right now about uh, carbon emissions. And there's a lot of talk about the 2050 goals of carbon neutrality and the 2025 goal of reducing oil consumption by 4 or 5 million barrels a day. Well, those are the stated objectives of some governments and major oil companies. And yet, when we look at forecasts for market growth, then the demand is likely to continue to increase. Now, oil prices are coming down. So even though stock markets have rebounded, the oil price has rolled over and it's down for 4 consecutive days now. And here also we have a very clear sequence of lower rally highs. So we can't say that this trend is over until it at least sustains a move up through $88. My guess, at least, is that what we're going to see next is a real test of the US government's resolve. They said that they would start refilling the strategic reserve in February. And they said that they're going to buy between 67.50 and 72.50 on West Texas Intermediate. Well, the price right now is at $75. So I think the market's going to test them. And if we start to see prices firming from that area, well, then that will be a green light for further interest in the energy sector. But I think investors are in a bit of a show me mood. And the energy spider, or the spider ETF, was down in a fairly dynamic manner in here today, but this isn't the first time it's pulled back from this area, and we're in the region of the peak from back in 2014, and we're in the region of the peak from back in 2008. So this is an area where uh, oil company stocks have peaked in the past, and it would suggest that there's no rush to be getting back into the energy sector. And certainly there is the potential that we could have a surprise if the US government's bluff is called and they don't come into the market with big buying to refill the strategic reserve at what I think most people understand would be pretty high prices. And I think with that, I'll leave you for today and I'll wish all the best to all of you.